growth has been very strong since the start of the year. And we see that in the data coming out, as you mentioned in your show, that Renault, French car maker, increased their profit margin expectations for next year, profit expectations for next year. And this is on the back of growth outlook, which has remained resilient. We believe that as we go through the cycle and as consumer savings get eroded on the back of higher inflation, you will start seeing growth break down, growth outlook slow, and that will drive earnings to slow down. Right now in Europe, what we see is profit margins are very high, almost 2.5 percentage point higher than the peak of pre-COVID era, and which we believe is not sustainable for a long period of time.
If we just drill into those profit margins, then it's a common feature. We're seeing higher volumes and higher price action and a lot of the numbers from corporates. What fades first? Is the volume or the price pressure that craters on the back of the macroeconomic environment?
That's a very good question. So we did a lot of quantitative studies to see what drives revenue slowdown and what drives profit margin slowdown. And long story short, what matters at the end of the day is when demand slows down, you tend to see revenues come under pressure, but at the same time, companies tend to lose their pricing power because you are in a higher competition, low volumes, and you try to compete to get those volumes. So I would say both of them slow together. When you start seeing headline GDP slow down, you will start seeing companies start losing pricing power, and then that will get reflected in profit margin weakness.
I wanted to ask you about your bank's call, Ankit, because you've, as far as I can see in the notes here, you've said that in terms of the trading ideas, long banks looks like an interesting proposition at this point. Just walk me through that one. So over the last 10 years, the reason why you would not have invested in European banks is because Europe was in a negative rate environment. And this year that has changed. Right now, if you look at the current earnings season, banks and oil and gas were probably one of the 2 star performers, and earnings are getting revised up, and we believe that is not yet reflected in the equity price performance. For next year, the key risk for the sector is loan loss provisions and the balance sheet quality for the sector. But we believe a lot of risk is already in the price. What we are looking for is a PMIs to trough and growth momentum to trough before we get more constructive on the sector. Right now, we are focusing on earnings aspect of the sector, which we believe will be resilient at least for the next 6 to 12 months.
Ankit, very good morning to you. Some people are typifying what we're seeing at the moment as the revenge of value over growth as well. I don't necessarily see it like that, I've got to be honest. But in terms of the growth sector at the moment, and we know the pain it's having, in fact, probably the inverse of what you were just saying there about the banking sector, there has to be an opportunity at some stage in growth. Are we anywhere near that opportunity yet?
I think you need to time the peak in inflation. Once inflation has peaked, then you could start thinking more constructively about growth factor. And what we learned from the non-farm payroll data last week, and we'll see the inflation data this week in the US, is inflation has far from peaked, so to say, and inflationary trends are still out there. That means central banks need to keep hiking rates. That means growth sector will remain under pressure. So even within growth sector, you need to differentiate between companies which are profitable and making money versus companies which are non-profitable. So profitable companies probably will benefit first, and you will start seeing those. You're already starting to see those companies outperform within the growth space.